Dear friends, the views expressed in this video are not the views of the managing committee, nor is the presentation a solicitation for any investment company. This is an educational video, and it is meant to inform the viewer about the avenues of investing society deposits. All the numbers and the figures are only indicative, so please refer to the official handouts of the society. Dear friends, welcome back. This is the third video, and in this video we shall be taking a look at some smarter investment opportunities that have become available to cooperative housing societies after the publication of the notification in the Gazette of India, about which we talked briefly in the previous video. The investments that a cooperative housing society can make is governed by the Maharashtra Cooperative Societies Act 1960. Section 70 deals with the rules governing investment of society funds, and Section 70A says that it can invest in any central bank or a state cooperative bank. And 70B is more general in that it says that any securities specified in Section 20 of the Indian Trusts Act 1882. Now that's a pretty old act, and there have been some provisions that have been made by the government in recent times. There's a new Government of India notification which has been published in the Gazette of India on 21st of April 2017. Let's see what these provisions are and what they allow us to do as a cooperative housing society. Section 20 of the Indian Trusts Act 1882, and you can access that on the URL given over here to see the PDF in original, and that is summarized over the next couple of slides. So a cooperative society can now invest in government securities, in securities whose principal and interest are guaranteed by the Government of India or any state government. So that includes your state development loan bonds and similar instruments. Mutual funds are regulated by SEBI. That's the regulator for equities and the markets in India. Further, it can invest in debt securities issued by corporates, banks, financial institutions, having a minimum AA or a AA rating of 2 agencies like ICRA, like CARE or CRISIL. Also, you can invest in Basel III Tier 1 bonds issued by a commercial bank under RBI guidelines with a minimum rating of AA from 2 agencies. Also, you can invest in infrastructure related debt instruments, once again with a minimum AA rating of 2 agencies. Continuing, shares of corporates with a market cap of more than 5,000 crores. So you can even invest in shares. Also allowed are mutual funds regulated by SEBI, which have a minimum 65% in shares of listed companies. That's what is covered usually by what is known as balanced mutual funds. And finally, you can also invest in index funds or electronically traded funds, ETFs, which replicate the Sensex or the Nifty index. So that's covering a very wide spectrum of investment and financial instruments. One thing I would like to say at the outset, that interest and bond prices have a very definite relationship. When one goes down, say the bond prices will go down when the interest rates go up. And what is the situation we are facing now? We are facing interest rates which are going down, which means that the bond prices will go up. That is so because bonds have been issued in the past when the interest rates were high, and they were priced at a certain dividend coupon rate so that you could make more profit as compared to keeping it in the bank. That was the reason why the bonds came out, to attract money from the markets. So if the interest rate goes up, the bond prices come down, because then people would invest in other instruments. So that is one thing to remember. If the interest rates are sliding down, bond prices are going to go up. Now, if you recall, in those three slides which covered those instruments of investment, one was a perpetual bond and another one was a Basel III bond of banks. So these bonds are available in the market. For instance, the IDBI 11.09% bond. So after paying taxes on that, it has a post-tax return of 8.33%, which is higher than what fixed deposits are giving today. The UCO Bank, once again, has got a 11.7% bond, and the post-tax return on that is 7.17%. The Bank of India bond similarly gives a post-tax return of 7.7, and the Bank of Maharashtra, this is a recent bond that came out earlier this year, sometime in the month of January, or rather in the month of December 2016, that gives you a post-tax yield of about 8.12%. Now, don't these names sound familiar? These are the same banks which are having a very high NPA, non-performing assets. And they have issued these bonds to bail themselves out under provisions provided by RBI. So they are perfectly safe, because even if these banks are to be amalgamated with bigger banks, then the bigger banks are going to carry this bond load along with them. So perpetual bonds are pretty safe instruments, and here are the returns that you are getting on them. Just compare them. If you recall, a fixed deposit in a nationalized bank or in a large public-private bank is going to give you a return of 4.6 or 4.7% return. The cooperative banks are going to give you 6.8%, and all these are well over 7%, all the way up to 8.33. Now let's look at what the public sector undertaking tax-free bonds with a AAA rating provide us in terms of effective yield. The National Highway Authority of India issued a bond about 3 years ago, and that was a 7.6% tax-free bond. The HUDCO, that is the Housing Urban Development Corporation bond, has got a coupon of 8.1%. The Indian Railway Finance Corporation is having a coupon rate of 7.53. But if you buy them in the market today, and as I said earlier, the bond price goes up when the interest rates are sliding down. So a bond that was available for 10,000 rupees, the HUDCO, for instance, will cost you somewhere close to 12,500. So the effective yield will not be what is shown here. But remember, these are tax-free bonds. Anything you earn on that is absolutely tax-free. And here are the returns. The Highway Authority of India gives you a return of 6.05. HUDCO is slightly lower than that, 5.76. And the IRFC is once again 6.05%. This is the tax-free return. This is still higher than the 4.7% return that we were getting after paying taxes on nationalized or large private banks. And you can see the maturity dates. They are more than 10 years in the future from now, 15 years to more than that. Debt fund is another instrument that is allowed under the new provisions of the Gazette of India. And these funds are made by banks or other financial institutions. And they are funds where the fund manager has collected a large number of instruments, and you are a participant in that, and that's how you call it a mutual fund. So there is one UTI dynamic bond, there is another Reliance regular saving, and a Kotak income opportunities. There are hundreds of them. I've just picked out 3 of them as illustrative examples. And here are the returns. And these bonds are giving you returns of anywhere between 10 to 13% depending on the time horizon. The Reliance regular saving program has been more steady over the past 5 years. hovering around 9.5, and the Kotak Income Opportunities is also somewhere close to that. Now, one thing we ought to remember is that these bonds are tax-free. They are tax-free because if you stay invested for 3 years, all the dividends that you're getting are absolutely tax-free. What you get in hand is tax-free. Now here are examples, the 3 bonds which I mentioned in the previous slide. This is where the money goes. Now you'll see that all the money has been invested in non-convertible debentures of all these companies: Reliance Utilities, Power Finance Corporation, which is a government or a PSU. You've got State Bank of India, Punjab National Bank, and they are all AA or AA plus or AAA companies. Another bond which I showed in the last slide was the Reliance Regular Savings Fund. Once again, they have got all AA investments, and you have seen the returns in the previous slide. All these bonds pay a dividend as a payout. This particular one is a quarterly dividend, QD. Another one here is a Kotak Income Opportunities Fund, and this one is a AD, which is an annual dividend. So you have various choices, and you can always see where the money is invested. Now, debt fund tax implications are very straightforward: tax-free dividends and easy liquidity. They are listed on the stock exchange, and it's T+10. That means if you want to liquidate it today, on the 10th day or earlier, you'll get the cash in hand. Another instrument of investment is a balanced fund. What it means is that you have got a component of 65% exposure to equity, and the remaining 35% is in bonds, or the debt market as they call it. The balance is struck between equity and debt. As you know, equity markets can fluctuate, but over the course of many years, the returns on equity is much better than fixed deposits or bonds. So it's a combination of two good instruments, equity and debt. And let's take a look at 2 bonds. As an illustrative example, we'll see 2 bonds after this slide. And once again, the tax implications for this are that they are tax-free dividends. And remember, there is an equity component of 65% minimum in order to qualify as a balanced fund with those tax exemptions. As I said, there are 2 examples here. One is the ICICI Prudential and the HDFC Prudence. You can see all this data, and it has been actually collected from the National Stock Exchange, the NSE website. And that changes every day, so I've not given you a link. All you do is you just go on that website and you can do a search. Here are the results for the past returns for the past 5 years. It's hovering between 15 to 20%. And the HDFC Prudence is hovering between 12 to almost 20%. So this is what you can expect with exposure to equity. Now let's take a look at where the money is invested. This is also available on the internet. It's a open affair. It's very transparent. Now the ICICI Prudential Balanced Fund has invested in all these companies in Cipla, ONGC, Grasim, Tata Motors, Power Grid Corporation. So it's a mixed bag of different sectors ranging from banking, finance, automotive, utilities, and pharmaceuticals. And they are all blue chip companies. That means they are the companies that directly affect the Sensex or the Nifty. The other fund that we saw in the previous slide is the HDFC Prudence Fund. And once again, you got a mixed bag consisting of the State Bank of India, ICICI, you got some tech companies like Infosys, engineering groups like Larsen and Toubro, and of course you got metals and mining like Tata Steel. It's once again top companies, all blue chip, and that's where the money comes from when it comes on long-term investment, and that's how the returns are close to 15 to 20%. Now we'll see if we were to create a mixed bag of investment, taking into account the precautionary stories that we hear about equities. This is one example that has been developed just to illustrate. If we were to put in 3 crore rupees out of the 8 crore that you have in your kitty, you could earn 7.4% tax-free. That means that's what you get in your hand. Tax-free bonds of public sector undertakings, 2 crores. The returns are a little lower, perfectly safe, guaranteed by the government of India. Perpetual bond, once again, of Basel III Tier 1, which is again a very sound instrument belonging to all those banks. And you must have noticed those were the banks which are having the high NPA, and that's why they are paying you a very high dividend. Even if you just stick in 1 crore rupees over there, you will get a guaranteed return of 7 lakhs on that, because that is a coupon rate after taxes, I mean. And if you just put in 1 crore in the balanced fund, which means out of that 1 crore, 65 lakhs will be exposed to equity, but your return is guaranteed to be a minimum 10%. When I mean the word guarantee, that is based on past statistical evidence. That could fetch you a whopping 12 lakhs. And 1 crore in fixed deposits with a cooperative bank with a low NPA, and that will fetch you 6.8 lakh rupees. If you add up all that, then that mixed bag return of debt, tax-free bonds, perpetual bonds, balanced fund, and a fixed deposit in a cooperative bank will give you a total which will look something like this. And that's a good 60.7 lakh rupees. So 60.7 lakh rupees plus your contribution at the rate of 3 rupees per square foot per month per flat will add up to 113 lakhs. That means 1 crore 13 lakhs and 48,000 rupees. Still short of what we'll need, including the sinking fund. If you remember or recall, that number is somewhere close to 1 crore 17 lakhs. So that is the situation which we are facing, not immediately, but which we will be facing after the 1st of April 2018. So these are hard decisions you'll have to take in this general body, because this particular budget will run only till 31st of March. After that, we have to decide where the money goes, because right now the money is lying with the builder. In any case, the builder has said, according to your agreement to sell, that you will have to take a call on that after 3 years. In addition to that, I told you about the conversation that the office bearers had with Mr. Sudesh Kataukar, who is the Chief Executive Officer of AHPL and MDPL, and he said that the builders are also looking at opportunities to return the money to the flat buyers and think of a new scheme. Now here is what we were told across the table in the CEO's office, and this is the builder's offer, although we have not received a written offer as yet. The salient features of this offer are 2% higher interest than the SBI rate, the State Bank of India rate. There is no written offer as yet, as I mentioned. And another point to remember is that the builder is not covered under Section 70 of the MCS Act, and it is not covered under the Gazette of India notification of 21st April. So taking that into account, one has to take a call on this. Of course, even now our money is lying with the builder, and it is not covered by any insurance scheme as we had seen in the earlier video, and nor is it covered under the Gazette of India. But of course, at that time, there was no cooperative society. Now that it is formed, you have to make a decision. It is your money, and you have to tell the builder what you want to do with it. Do you want it back so that you can invest it personally, or you want that to be handed over to the society, where you will make a decision and give a directive as to where the money goes, or you would like to consider the offer made by the builder. And another thing to remember is that the builder's company is not a listed company. They have not made an IPO so far. That builder's company is not traded on the stock exchange. So it is not having any rating. When we were talking about those AA and AAA ratings, The PSCL, MDPL, AHPL don't come into that category at all. Now let us take a call on the builder's verbal offer and do our arithmetic. The State Bank of India rate today for a 1-year term, which is the highest rate, is 6.75%. So the builder will give 2% higher, which means it will be 8.75%. The income that will be generated on 795 lakh rupees will come to 69.56 lakhs. But it will be adjusted against services provided by AHPL. So there will be an 18% goods and services tax GST applied on that. So what will really be available after deducting that amount, the net return will be 57 lakh rupees. Now this graphic will do a comparison of the three options that we have discussed in the 3 videos so far. One is of course the mixed bag option, where the funds have been invested in perpetual bonds, in balanced fund, in a debt fund, in fixed deposits, and in tax-free bonds of government public sector undertaking units. We'll see the returns on a cooperative bank and the builder's offer if that materializes. So the mixed bag gives us an income after all taxes equal to 60.7 lakhs. Cooperative banks will give us a return of 52.25 lakhs. And the builder's offer is in between the two, and it is 57 lakhs. So that is where you have to weigh and discuss and then come to a conclusion at the general body meeting. That brings us to the end of this video, and I'll summarize the points that were discussed. We talked about the Maharashtra Cooperative Societies Act Section 70 and how it has been affected by the new Gazette of India notification of April 2017. We had a look at perpetual bonds, the Basel III Tier 1 bonds issued by public sector undertaking banks. We had a look at the public sector undertaking tax-free bonds and their returns. We looked at debt funds, which normally have a bag of the above two instruments and some government securities to give us a return. Then we took a look at balanced funds, where the money is exposed, 65% of your money is exposed to equity. Then we had a look at the builder's verbal offer also. In the next video, which is the last in the series of 4, we'll take a look at where are the possible avenues of saving money. And that will give you a fair idea what to expect when you get a call for your money for payment to the society to raise funds. Thank you very much for your attention, and see you in the next video soon. Bye bye.